There is a question. It is a simple question, but it functions like a master key, unlocking the most heavily guarded vault in the world of finance. It's not a question about price-to-earnings ratios, discounted cash flow, or the intricacies of a balance sheet. It's a question about human nature, a question that cuts through the noise of quarterly earnings calls, the polished presentations of investor relations, and the grand pronouncements of charismatic leaders. It bypasses the spreadsheet and goes straight for the soul. It is the one signal, the final promise, that separates the hired hand from the true partner, the mercenary from the missionary. Imagine you are sitting across from the chief executive officer of a company you've poured your hard-earned savings into. You've studied the business, you believe in the product, you see the potential for massive portfolio growth. But there is a nagging doubt, a whisper of uncertainty that keeps you up at night. Is this person, this well-compensated executive in the corner office, truly in the boat with you? Or are they merely the captain of a ship they are prepared to abandon at the first sign of a storm, leaving you and your capital to go down with it? The question you must ask, the thought experiment you must run, is this. Mr. or Ms. CEO, if you were forced right now to take every single dollar of your family's net worth, the house, the savings, the college funds for your children, every last cent, and invest it all in a single stock to be held for the next 10 years, would it be this one? Would it be the shares of the very company you lead? The silence that follows that question is where the truth lives. The flicker in their eyes, the slight hesitation, the carefully crafted corporate speak that might emerge instead of a simple resounding yes. That is your data, because this question isn't about their confidence in next quarter's earnings. It's about their conviction in the next decade's survival and prosperity. It is the ultimate test of skin in the game. This is the principle that separates the greatest investors, like Warren Buffett, from the 99% of market participants who are perpetually confused about why they lose money. They make a costly, catastrophic market mistake. They invest alongside management teams who have little to none of their own money at risk. They align their capital with people whose interests are, at best, tangential to their own, and at worst, directly opposed. The CEO, who is paid a massive salary and a bonus for hitting short-term targets, has an incentive to make the next 3 months look good, even if it means sacrificing the next 10 years. They might slash research and development, take on dangerous leverage, or pursue a foolish, empire-building acquisition. Their upside is a bigger bonus. Their downside is cushioned by a golden parachute. Your upside as a shareholder is tied to the long-term health of the enterprise. Your downside is the permanent loss of your capital. This is not a partnership. It is a profound and dangerous misalignment. But what if you could change that? What if you could systematically eliminate this risk from your investment process? The financial transformation we are about to embark on is rooted in this single, powerful idea. You must prioritize companies where the managers eat their own cooking. You must seek out the owner-operators, the founders, the families, the executives who have a staggering, almost irrational percentage of their personal wealth tied up in the same stock you own. When you do this, the entire dynamic shifts. The CEO is no longer just your agent, they are your partner. Your capital is no longer a line item on a corporate budget. It is an extension of their own family fortune. They will treat your investment with the same obsessive care, the same paranoid diligence, and the same long-term perspective that they treat their own. They will think about risk differently. They will allocate capital more prudently. They will build a fortress-like balance sheet not because a textbook tells them to, but because they are terrified of losing their own money. This alignment of interests is the single most powerful, yet most overlooked tailwind an investor can have. It is the secret weapon that allows you to sleep soundly at night, knowing that the people in charge are not just working for a paycheck. They are working to build lasting value because their own financial destiny depends on it. This is the story of that principle, the psychology behind it, and the practical blueprint you can use to make it the cornerstone of your own journey toward financial freedom. Our journey begins not in a modern boardroom but in a modest office in Omaha, Nebraska in the late 1950s. A young man in his 20s, Warren Buffett, is about to launch a series of investment partnerships that would become the stuff of legend. But the way he structured these partnerships contains the entire genetic code of his future success. It is the foundational anecdote for our first and most crucial pillar, the principle of absolute alignment. In 1956, when Buffett started his first partnership, he wasn't the globally recognized, quote, Oracle of Omaha. He was a bright, ambitious, but relatively unknown student of the great Benjamin Graham. He had to convince a small group of people, mostly family and friends, to entrust him with their money. He gathered them in an Omaha hotel for a simple dinner and laid out his proposition. And what he proposed was radically different from the Wall Street norm. He wasn't asking for a standard management fee, where the fund manager gets paid a percentage of assets regardless of performance. That, he instinctively knew, was a recipe for misalignment. A manager paid on assets is incentivized to gather more assets, not necessarily to generate the best returns. Instead, Buffett structured his partnership, which would eventually be consolidated into the Buffett Partnership Limited, with a deal that was almost absurdly shareholder-friendly. He called it his 0 plus 6 inches fee structure. First, the zero. Buffett would take absolutely no management fee. Zero. He would not make a single penny unless his partners made money first. This immediately communicated a powerful message: I only win if you win. Second, the 6. The partners would keep all profits up to an annual return of 6%. This was their hurdle rate. In an era of low interest rates, a guaranteed 6% was a fantastic deal for them. It meant Buffett had to clear a respectable return before he could even think about getting paid. But here's where the genius of the alignment came in. After that first 6% was paid to his partners, Buffett would receive 25% of all the profits above that level. This gave him a massive incentive to not just do okay, but to knock the cover off the ball. It aligned his desire for extraordinary returns with his partners. But the most important piece of this puzzle, the element that sealed the deal and created a bond of unbreakable trust, was Buffett's own capital. He took nearly his entire personal net worth at the time, a sum of about $25,000, and put it into the partnership right alongside his family and friends. He wasn't just managing their money, he was managing our money. When he spoke to his partners, he didn't use the language of an agent. He didn't say your portfolio or your capital. He said our partnership and our investments. This was not a semantic trick. It was a reflection of a profound reality. His financial fate was inextricably linked with theirs. If the partnership had a bad year and lost money, he felt that pain more acutely than anyone, not just because his reputation was on the line, but because his own family's financial security was at risk. He was eating his own cooking, in the most extreme way imaginable. This structure, this absolute skin in the game, had transformative effects. It allowed him to demand the one thing he needed most to let his investment process work: patience. In his partnership letters, he was famously candid. He told his partners that his style of investing was lumpy, that there would be years when they would underperform the market, and that if they were looking for quick, smooth returns, they should go elsewhere. Because his partners knew his own money was on the line, they gave him that patience. They trusted that he wasn't taking foolish risks, because any loss would be his loss too. They understood that when he chose to sit on cash and do nothing for long periods, it wasn't out of laziness. It was out of a deep-seated fear of losing their collective capital. This wasn't just an investment strategy, it was a moral compact. The results, of course, were staggering. From 1957 to 1969, the Buffett partnership generated a compound annual return of 29.5%, absolutely crushing the Dow Jones Industrial Average. He never had a down year. He made his partners and himself very wealthy, but the wealth was a byproduct of the structure. The foundation was alignment. The lesson from this early chapter of Buffett's life is crystal clear. The most powerful force in business and investing is the alignment of interests. When the person making the decisions has the same risk and reward profile as the people they represent, the entire system self-corrects for prudence, long-term thinking, and rational behavior. This powerful narrative of Buffett's early partnership isn't just a quaint story from financial history. It's a perfect illustration of a deep and often misunderstood psychological principle, the principal-agent problem, supercharged by what Charlie Munger calls incentive-caused bias. Understanding this is critical to appreciating why skin in the game isn't just a nice-to-have, but an absolute necessity for successful long-term investing. The principal-agent problem is a concept from economics that describes the inherent conflict of interest that arises when one person, the quote, agent, is hired to act on behalf of another, the principal. In the corporate world, shareholders are the principals. They are the owners of the company. The management team, from the CEO down, are the agents, hired to run the company for the benefit of the owners. In a perfect world, the agents would always act in the best interests of the principals. But the world is not perfect. The agent has their own set of interests: career advancement, salary, bonus, reputation, personal comfort. These interests often diverge from the principal's primary interest, which is the long-term maximization of the company's per-share intrinsic value. This divergence is where the trouble begins. Charlie Munger famously said, "Show me the incentive and I will show you the outcome." This is the core of incentive-caused bias. Human beings are not purely rational creatures. We are heavily, and often unconsciously, influenced by the incentive structures we operate within. If a CEO's bonus is tied to hitting a specific quarterly earnings per share target, their brain will subconsciously start to favor actions that achieve that target, even if those actions are detrimental to the long-term health of the business. They might delay a crucial but expensive factory upgrade, cut the marketing budget for a promising new product, or use accounting gimmicks to pull revenue forward from the next quarter. They aren't necessarily being malicious. Their brain is simply following the reward system laid out for them. They are being perfectly rational in the pursuit of their own self-interest, as defined by their compensation plan. This is the path of the 99% of corporate structures. They create a system where the agent, the CEO, is playing a different game than the principal, the shareholder. The CEO is playing for the next bonus check. The shareholder is playing for the next decade of compounded growth. Skin in the game acts as a psychological short-circuit to this entire problem. When a CEO has a massive portion of their own family's net worth invested in the company, they cease to be just an agent. They become a principal. Their identity shifts. The principal-agent problem dissolves because the principal and the agent are now the same person. The incentive structure is no longer an external document crafted by a compensation committee. It is an internal, visceral reality. The fear of losing their own money, a psychological force far more potent than the desire for a slightly larger bonus, becomes the dominant driver of their decision-making. This is why Buffett's structure was so brilliant. By investing his own money and taking no fee unless he performed, he wasn't just aligning incentives. He was fusing his identity with that of his partners. A loss for them was a direct, personal, and painful loss for him. His brain, therefore, was wired not to maximize his fee, but to minimize the risk of permanent capital loss for the entire group. This is a fundamental rewiring of the cerebral hardware that governs corporate decision-making. So how do we, as retail investors and entrepreneurs, translate this powerful psychological insight into a practical, repeatable process? We need an applied mental model, a blueprint we can use to screen every potential investment. We can call it the family net worth thought experiment. It's a multi-step process for evaluating the true alignment of any management team. Step 1 is to move beyond the headlines. The financial media loves to talk about charismatic CEOs, visionary products, and disruptive technologies. These are stories, and stories are compelling. But they are often noise. Your first step is to ignore the story and go straight to the data. The key document here is the company's annual proxy statement, also known as the DEF 14A, which is filed with the Securities and Exchange Commission and is available for free on any company's investor relations website. This document is the ground truth. Step 2 is to locate the security ownership of certain beneficial owners and management table within that document. This table is your treasure map. It lists the top executives and directors and tells you exactly how many shares of the company they own. This is not an estimate. It is a legally required disclosure. Step 3 is the quantitative analysis. Don't just look at the raw number of shares. That can be misleading. A CEO of a mega-cap company might own 1 million shares, which sounds impressive, but it could represent a tiny fraction of the total shares outstanding and an even tinier fraction of their personal wealth. You need to calculate 2 key metrics. First, what percentage of the company's total shares does the management team and board own collectively? A figure above 5% is interesting, above 10% is compelling, and above 20% is often a sign of a true owner-operator culture. Second, and this is more of an art, you need to estimate the value of their holdings relative to their compensation. Look up the CEO's total annual compensation, which is also detailed in the proxy statement. If the CEO's stock ownership is valued at, say, $5 million, but their annual salary and bonus is $10 million, their alignment is weak. They make twice as much from their paycheck as they have at risk in the stock. Their primary incentive is to protect the paycheck. But if the CEO's stock ownership is valued at $50 million and their annual compensation is $2 million, the dynamic is completely different. They have 25 times more money at risk in the stock than they earn in a year. They are not working for a salary. They are working to protect and grow their own massive equity stake. Their interests are now firmly aligned with yours. Step 4 is the qualitative analysis, the core of the thought experiment. Read the CEO's annual letter to shareholders. Listen to their language on conference calls. Are they speaking like an owner or an agent? An owner talks about our capital, our company, and thinks in 5 to 10-year time horizons. They speak candidly about mistakes and challenges. An agent talks about the quarter, hitting the numbers, managing expectations, and often uses jargon to obscure reality. The owner is communicating with partners. The agent is managing a public relations narrative. Finally, apply the ultimate question. Based on all this evidence, their percentage ownership, the ratio of their equity to their salary, and the language they use. If this person had to put their entire family net worth into one stock for 10 years, is there a credible chance it would be this one? If the answer is a clear, unhesitating yes, you have likely found a situation where your capital will be treated with the sanctity it deserves. You have found a true partner. To truly appreciate the power of this model, we must dedicate ourselves to understanding its opposite. We must explore the antithesis, the path of the 99% of investors who consistently ignore this crucial signal. This path is littered with the wreckage of companies led by misaligned managers, and it provides a stark warning about the consequences of betting on a jockey who has no stake in the race. The most common mistake is being seduced by the hired gun CEO. This is the executive with a glittering resume, an MBA from a top school, and a track record of turnarounds at other companies. They are brought in with great fanfare, awarded a massive compensation package heavy on cash and short-term stock options, and celebrated in the financial press as a savior. The retail investor, swayed by this social proof and herd mentality, piles into the stock. But the hired gun's incentives are almost always perverse. Their goal is not to build lasting value. Their goal is to create a short-term pop in the stock price, allowing them to cash in their options and move on to the next lucrative gig. Their playbook is predictable. Engage in aggressive cost-cutting that harms the long-term competitive position of the business. Take on debt to fund a massive share buyback that juices earnings per share in the short run. And pursue a flashy transformational acquisition that adds complexity and risk but generates positive headlines. They are playing a 3 to 5 year game. You, the long-term investor, are playing a multi-decade game. You are not on the same team. Another common pitfall on the path of the 99% is the obsessive focus on stock options as a form of alignment. The argument promoted by corporate compensation consultants is that granting executives options to buy stock aligns their interests with shareholders. This is a dangerous half-truth. Standard stock options are a heads I win, tails you lose proposition for the executive. If the stock goes up, they exercise the options and make a fortune. If the stock goes down or stays flat, they lose nothing. This one-way bet encourages excessive risk-taking. A CEO with a boatload of options is incentivized to swing for the fences, to gamble the company's future on a high-risk, high-reward strategy. If it pays off, they become fabulously wealthy. If it fails, and the company is crippled or goes bankrupt, they walk away, their personal net worth largely intact. The shareholder, on the other hand, bears the full brunt of the downside. Real alignment comes from outright stock ownership, preferably purchased with the manager's own money on the open market. Ownership means you participate in 100% of the downside, just like every other shareholder. This fear of loss, not the greed for a potential gain, is what truly focuses the mind and ensures prudent decision-making. The 99% ignore this distinction. They see options and think alignment, a catastrophic analytical failure. The ultimate destination on this path of misalignment is the company that prioritizes empire building over per-share value. The agent CEO is often driven by ego and a desire to preside over a larger, more prestigious organization. Their compensation is often tied to the size of the company, its revenues or total assets, rather than its profitability or return on capital. This creates a powerful incentive to acquire other companies, even at absurdly high prices. For the CEO, a big acquisition means more power, a bigger office, more media attention, and a higher salary. For the shareholder, it often means their ownership stake is diluted to buy a mediocre business at a premium price, destroying value in the process. The 99% of investors cheer for these deals, seeing them as signs of boldness and vision. The intelligent investor, who has done the alignment analysis, sees them as a giant red flag, a signal that the CEO is using shareholder money to build their own monument. By consistently choosing this path, by investing with agents instead of owners, the average investor guarantees a portfolio filled with companies that are managed for the short term, prone to foolish risks, and destined for mediocrity. They are swimming against the powerful tide of human incentives, a struggle they are almost certain to lose. The financial connection between shareholder alignment and superior returns is not theoretical. It is a direct, quantifiable, and massive advantage that manifests on the income statement, the balance sheet, and ultimately, in your brokerage account. Understanding this connection is the final step in cementing this principle as the bedrock of your investment philosophy. Let's start with the most important decision any CEO makes: capital allocation. A business generates cash. The CEO then has 5 choices: reinvest in the core business, acquire another business, pay down debt, issue a dividend, or buy back stock. An agent CEO, driven by short-term incentives, will often make poor decisions here. They'll reinvest in pet projects with low returns to grow their empire, or they'll buy back stock at wildly inflated prices just to hit an earnings per share target. An owner-operator, whose own fortune is on the line, treats that cash as sacred. It is their money. They will be fanatically disciplined, reinvesting it only when they are convinced the incremental return on invested capital is high. They will only make acquisitions when the price is a bargain and the strategic fit is perfect. They will only buy back stock when they know it is trading for significantly less than its intrinsic value. This discipline in capital allocation is the single greatest driver of long-term value creation. Better capital allocation leads directly to a higher return on equity, which, over time, is the engine of compounding per-share value and consequently a rising stock price and substantial capital gains. Next, consider the balance sheet. An agent CEO might be comfortable taking on significant debt. Leverage can juice returns in the short term, boosting return on equity and potentially their bonus. The risk of bankruptcy in a downturn is a remote problem for them. They'll likely have moved on to another company by then. An owner-operator, on the other hand, is terrified of debt. Debt is what causes sleepless nights. Debt is what can lead to the permanent loss of their family's capital in a single economic shock. As a result, companies run by owner-operators almost always have fortress-like balance sheets with very little debt. This financial conservatism might seem boring during a bull market, but it provides incredible resilience during a recession. Not only does it allow the company to survive, but it also provides the dry powder to acquire distressed competitors at bargain prices, emerging from the downturn stronger than ever. This directly translates into lower risk and higher long-term portfolio growth for shareholders. Finally, there's the connection to operational efficiency. Owner-operators are often frugal to a fault. They watch every penny because it is, in a very real sense, their penny. This isn't about being cheap. It's about being efficient. They despise waste, bureaucracy, and corporate excess. Think of Warren Buffett still working from the same modest office in Omaha for over 50 years. This fanatical focus on cost control flows directly to the bottom line. Lower operating expenses mean higher profit margins. Higher profit margins mean more cash generated for intelligent capital allocation. It is a virtuous cycle. The financial impact is not trivial. Numerous academic studies have shown that, over long periods, portfolios of companies with high insider ownership significantly outperform the broader market averages. This is the skin-in-the-game premium. By screening for this single factor, you are tilting the odds dramatically in your favor. You are harnessing the most powerful force in the universe, self-interest, and making it work for you, not against you. This is how you move from gambling on stock tickers to investing in businesses alongside trusted partners. It is the direct path to building lasting wealth and achieving true financial independence. Now we turn our attention to the ultimate case study in this philosophy, the living embodiment of eating one's own cooking, Berkshire Hathaway itself. To understand Warren Buffett's strategy for evaluating other companies, you must first understand how he has structured his own life's work. This is our second pillar, the Berkshire Hathaway case study, a masterclass in the power of putting your money where your mouth is. The foundational anecdote here isn't a single transaction, but the very architecture of the company and Buffett's relationship to it. As of the early 2020s, Warren Buffett's personal net worth was well over $100 billion. More than 98% of that immense fortune was, and still is, held in a single stock, Berkshire Hathaway Class A shares. Let that sink in. The man widely regarded as the greatest investor in history has nearly his entire fortune concentrated in one single investment. He is not diversified in the traditional sense. His skin is not just in the game, he is the game. His financial well-being is not just aligned with his shareholders, it is identical. If a Berkshire shareholder loses 1% of their investment, Warren Buffett loses over $1 billion. This is the most extreme example of shareholder alignment in the history of modern capitalism. This concentration is not just a matter of personal finance, it is the philosophical core that dictates every decision the company makes. It explains Berkshire's famous preference for acquiring entire businesses rather than just buying small stock positions. When Buffett and his partner Charlie Munger looked to buy a company like See's Candies in 1972, they weren't just analyzing the balance sheet. They were analyzing the See family. They saw a family that had poured their lives into the business, that cared deeply about the quality of the product and the well-being of their employees. They were buying a culture of ownership, not just a set of assets. After the acquisition, Berkshire's model was, and is, to leave these owner-minded managers in place. They buy great businesses run by great people, and then they get out of the way. This is a structure built entirely on the principle of alignment. Berkshire's headquarters in Omaha is famously tiny, with a staff of only a few dozen people. There is no bloated corporate bureaucracy, no army of MBAs dictating strategy to the subsidiary companies. Why? Because Buffett and Munger trust the managers they've partnered with. They know that the CEO of Nebraska Furniture Mart or Precision Cast Parts is already incentivized to do the right thing because they are owners themselves. This decentralized model is only possible because its foundation is built on a network of aligned interests. The psychological principle underpinning this entire structure is a powerful combination of two cognitive biases: the endowment effect and commitment and consistency bias. Understanding these biases reveals why Buffett's extreme concentration in Berkshire isn't reckless. It's a strategic tool for enhancing decision-making. The endowment effect, first identified by behavioral economists like Richard Thaler, describes our tendency to value something more highly simply because we own it. If you are given a coffee mug and then offered the chance to sell it, you will typically demand a much higher price for it than you would have been willing to pay to acquire it in the first place. Ownership itself adds a perceived value. Now imagine this effect scaled up to the level of Warren Buffett. His ownership of Berkshire isn't passive, it's the central fact of his identity. The company is not just an asset, it is his life's work. The endowment effect in his case transforms into a profound sense of stewardship. He values the company far beyond its quoted market price, leading him to protect it with a ferocity that a mere agent, a hired gun CEO, could never replicate. This intense psychological ownership fosters an obsessive focus on avoiding any action that could cause permanent harm to the institution. It's why he is so averse to leverage and so focused on moats or sustainable competitive advantages. He is not just managing a portfolio, he is protecting his legacy. Complementing this is the commitment and consistency bias. This is our deep-seated psychological need to be consistent with things we have already said or done. Once we make a decision or take a stand, we face personal and interpersonal pressure to behave consistently with that commitment. Buffett has spent over half a century publicly committing, in his annual letters and at his shareholder meetings, to a set of core principles: rationality, patience, and integrity. His entire reputation is built on this commitment. Because his entire net worth is also tied to the same enterprise, the financial and psychological incentives are perfectly fused. He is committed to Berkshire's long-term success with both his wallet and his word. This creates an incredibly powerful feedback loop. His public commitments force him to act rationally, and his massive ownership stake ensures that he has the strongest possible incentive to do so. A typical CEO might be tempted to stray from a stated strategy if short-term pressures mount. They can always rationalize the change as adapting to a new environment. For Buffett, straying from his committed path would not only risk his fortune, but would also shatter his life's work and public identity. This powerful combination of endowment and consistency creates what he calls a seamless web of deserved trust. Shareholders trust him because his actions have been remarkably consistent for decades, and they know his incentives are identical to their own. This trust is Berkshire's greatest asset, allowing him to operate with a degree of freedom and a long-term perspective that is simply impossible for the vast majority of public companies. How can an individual investor apply the lessons from Berkshire's unique structure? The mental model here is what we can call the decentralized conglomerate approach to portfolio construction. It's about shifting your mindset from a stock picker to a capital allocator who partners with great owner-operators. The first step is to recognize that you cannot and should not try to replicate Buffett's extreme concentration. You are not Warren Buffett, but you can adopt the underlying philosophy. Instead of buying dozens of stocks in an attempt at diversification, aim to build a more concentrated portfolio of 10 to 15 businesses that you know intimately and that meet the stringent skin-in-the-game criteria. Think of yourself as the CEO of U Inc. and your portfolio as a holding company. Each stock you buy is not a ticker symbol, it is an operating subsidiary. Your job is not to manage the subsidiary, but to hire the absolute best manager for it and then let them do their job. Step 2 is the hiring process. This is where your deep dive into proxy statements, annual letters, and conference calls comes in. Your goal is to find those rare CEOs who think and act like owners. You are looking for managers who have a significant portion of their net worth in the stock, who speak in plain language, who admit mistakes, and who have a clear, rational plan for allocating capital over the long term. You are essentially hiring a CEO for your subsidiary. You wouldn't hire someone to run a critical part of your business without doing intense due diligence on their character and incentives, so why would you do it with your investment capital? Step 3 is what Buffett does best: intelligent inaction. Once you have hired a great owner-operator by investing in their company, your job is largely done. You must resist the urge to constantly check the stock price, to trade in and out based on news headlines, or to second-guess the manager's every move. You have delegated the responsibility to them. Your primary role now is to monitor them from a distance, primarily by reading the annual report each year to ensure they are still behaving like rational owners and that the core principles of alignment remain intact. If they are, you do nothing. You let them compound your capital for you. This model transforms the frantic, often counterproductive activity of the average investor into a calm, patient, and business-like process. It forces you to focus on what truly matters: the quality of the business and the integrity and alignment of the people running it. By building your own personal, decentralized conglomerate of well-managed, owner-operated businesses, you are directly applying the Berkshire Hathaway blueprint to your own asset allocation, dramatically increasing your chances of achieving long-term financial freedom. The antithesis to this model, the path trodden by the 99%, is the approach of the corporate raiders and slash-and-burn private equity firms that Buffett and Munger have so often criticized. This mindset, which became prevalent in the 1980s, treats companies not as productive enterprises to be nurtured, but as collections of assets to be bought, stripped, and flipped for a quick profit. The Raiders model is the polar opposite of Berkshire's. They identify a company, often using large amounts of borrowed money, loading the company itself with debt in a leveraged buyout. Their goal is not long-term operational improvement, it is short-term financial engineering. They will fire employees, sell off valuable divisions, slash capital expenditures, and do whatever it takes to extract cash quickly to pay down the debt and pay themselves handsome fees. Their skin in the game is often minimal, and their time horizon is short, typically 3 to 5 years. They're the ultimate agents with no loyalty to the business, its employees, or its long-term future. Their only interest is in maximizing their internal rate of return on a specific deal. The average investor often makes a similar, albeit less dramatic, mistake. They adopt a trader's mindset instead of an owner's mindset. They jump from stock to stock, chasing the latest hot trend or story. They are attracted to companies promising rapid, disruptive growth, often led by charismatic but unaligned CEOs. They don't think of themselves as a permanent owner of a business. They think of themselves as a temporary holder of a stock certificate. This approach is antithetical to the Berkshire model of patient, long-term partnership. Buffett famously said his favorite holding period is forever. The trader's favorite holding period might be a few weeks or months. This short-term focus makes them susceptible to all the tricks of the misaligned agent CEO. They are the ones who get excited by the debt-fueled share buyback, who cheer for the risky acquisition, and who sell in a panic during a market downturn, precisely when the owner-operator is patiently looking for opportunities. By failing to adopt the patient, partnership-based model of Berkshire, the 99% of investors ensure they are always playing the other side of the game from the truly intelligent investors. They provide the liquidity that allows the patient owner to accumulate shares at attractive prices, and they buy those same shares back at inflated prices during periods of euphoria. They are, in essence, the prey in an ecosystem where the owner-operators are the apex predators. The direct financial connection of the Berkshire model is the awe-inspiring magic of long-term compounding, protected by a culture of extreme risk aversion. The financial statements of Berkshire Hathaway are a testament to the power of this philosophy. First, consider the concept of float. Through its massive insurance operations, Berkshire collects premiums from customers up front and pays out claims later. In the interim, it gets to invest this float for its own benefit. An ordinary insurance company, run by agent managers, would be under pressure to invest this float in safe but low-yielding bonds to ensure they can always meet their obligations. Buffett, the owner, understood that if they could consistently underwrite insurance at a profit, meaning premiums exceeded claims and expenses, then the float was better than free money. They were actually being paid to hold it. This insight, born of an owner's mindset focused on long-term value, allowed him to invest the float in higher-returning assets like public stocks and entire companies. This created a dual-engine machine, a profitable insurance business feeding an investment portfolio, which in turn generated capital to grow the insurance business. This is a structural advantage created entirely by an owner's perspective, one that a typical agent's CEO, focused on quarterly earnings, would never have been allowed to build. Second, look at the impact on Berkshire's book value per share. Over the decades, from 1965 to the present day, Berkshire's book value has compounded at a rate that has massively outpaced the S&P 500. This is the direct, mathematical result of disciplined capital allocation. Every dollar of retained earnings was treated as Buffett's own money. It was reinvested with an obsessive focus on generating the highest possible long-term return. There were no wasteful diversification acquisitions, no foolish buybacks at inflated prices. The result is a smooth, relentless upward march in the underlying intrinsic value of the business. The stock price follows this intrinsic value over time, creating enormous capital gains for long-term shareholders. Finally, the financial connection is seen in its resilience. Berkshire has navigated numerous recessions, market crashes, and financial crises not just by surviving but by thriving. Its fortress balance sheet, a direct result of Buffett's ownership-driven aversion to risk, allowed it to become a provider of capital during the 2008 financial crisis, making lucrative investments in companies like Goldman Sachs and Bank of America at bargain prices when everyone else was panicking. This ability to play offense when others are forced to play defense is perhaps the greatest financial advantage of the owner-operator model. It transforms market volatility from a threat into an opportunity, ensuring that wealth is not just built during the good times, but is fortified and magnified during the bad. This is the ultimate financial promise of aligning with owner-operators. You are investing in a system designed not just for growth, but for permanent, enduring success. We now arrive at our third pillar, where we peel back the layers and examine the raw, cerebral mechanics at play, the psychology of ownership versus agency. This isn't about business strategy. It's about the fundamental wiring of the human brain. The difference between how an owner-operator thinks and how a hired agent thinks is not a matter of intelligence or skill. It is a chasm in psychological perspective, and crossing it is key to your financial success. Our foundational anecdote for this pillar is the remarkable story of Rose Blumkin, better known as Mrs. B, the founder of the Nebraska Furniture Mart. Her story is perhaps the purest example of the ownership mindset that Buffett has ever encountered. Mrs. B was a Russian immigrant who arrived in America in 1917, unable to speak a word of English. In 1937, with a loan of just $500, she started a furniture store in the basement of her husband's pawn shop in Omaha. Her business philosophy was brutally simple: sell cheap and tell the truth. She worked with a fanatical intensity 7 days a week, haggling with suppliers for the best prices and passing those savings directly to her customers. She saw every dollar of inventory, every inch of store space, as her own. Her competitors, run by salaried managers, couldn't compete with her. They had budgets and marketing departments. She had an obsessive, all-consuming drive to provide value because the business was not a job, it was an extension of her own life. In 1983, a then 89-year-old Mrs. B was ready to sell her business. The buyer was Warren Buffett. The negotiation was legendary. There were no investment bankers, no teams of lawyers conducting months of due diligence. Buffett simply asked her for a price. She gave him a number. He looked at her books, saw they were honest, and accepted. The entire deal was done on a 2-page contract and a handshake. Buffett didn't need to scrutinize every line item, because he wasn't just buying assets. He was buying the character of Mrs. B. He knew he was partnering with the ultimate owner-operator. But the story doesn't end there. Mrs. B continued to work at the store. A few years later, at the age of 95, she got into a dispute with her grandsons, who were then managing the business. Frustrated, she quit in a huff. But what does a 95-year-old force of nature with an ownership mindset do? She doesn't retire. She crossed the street and opened a rival furniture store called Mrs. B's Clearance and Factory Outlet, with the explicit goal of competing against the very business she had sold to Buffett. It quickly became the third largest carpet retailer in Omaha. Buffett, far from being angry, was delighted. He saw this as the ultimate proof of her indomitable owner's spirit. He eventually bought the new store from her as well, and she continued working until she was 103 years old. The story of Mrs. B is a perfect illustration of the psychological core of ownership. Her drive didn't come from a compensation plan, it came from within. The business was her identity. Its success was her success. A customer getting a good deal felt like a personal victory. An inefficiently managed storeroom felt like a personal failure. This is a mindset that cannot be taught in business school or replicated with a clever bonus structure. It must be lived. The underlying psychological principle that explains the behavior of owner-operators like Mrs. B is one of the most powerful biases in human psychology: loss aversion. Coined by Daniel Kahneman and Amos Tversky, the pioneers of behavioral economics, loss aversion describes the empirical finding that for most people the pain of losing something is psychologically about twice as powerful as the pleasure of gaining something of equal value. Losing $100 feels as bad as gaining $200 feels good. This simple asymmetry has profound implications for financial decision-making. The typical agent CEO, with a large salary and stock options, is playing primarily on the gain side of the equation. Their compensation structure is designed to reward upside. A good quarter means a bonus. A great year means a massive payout on their options. The downside, a loss of their job, is certainly painful, but it's often cushioned by a generous severance package. Their personal net worth is not typically at catastrophic risk. Their mental framework is geared toward achieving gains. The owner-operator, on the other hand, lives in a world dominated by the fear of loss. When a significant chunk of your family's net worth is tied up in a single enterprise, your primary psychological driver is not the thrill of hitting a new high. It's the terror of going to zero. The pain of potentially losing the family business, the source of your security and identity, is so immense that it overrides almost every other consideration. This profound sense of loss aversion forces a different kind of calculus. Decisions are not filtered through the question, what is the potential upside, but rather, what is the worst possible outcome and can I survive it? This leads directly to the kind of behavior that long-term investors should cherish. It fosters a deep-seated conservatism. Owner-operators will be slower to take on debt, more reluctant to engage in risky, speculative ventures, and more insistent on maintaining a strong balance sheet. They build moats around their business not just to earn higher returns, but to create a buffer against the unpredictable shocks that can lead to ruin. Mrs. B's obsession with low prices and customer loyalty wasn't just a clever marketing tactic, it was a survival strategy. She was building a base of customers so loyal that her business could withstand any recession or new competitor. She was minimizing the chance of a catastrophic loss. When you invest with a management team that has this psychological profile, you are harnessing the powerful force of loss aversion for your own benefit. Their fear becomes your safety net. Their conservatism becomes your shield against market volatility. You are aligning your capital with the most potent survival instinct in the human psyche. To apply this psychological insight, we need a mental model that goes beyond the numbers in a proxy statement. We need a qualitative tool for assessing the culture of a company. This is the scuttlebutt method for assessing mindset, a term popularized by the legendary investor Philip Fisher and heavily utilized by Buffett. It's about listening for the subtle cues that reveal whether you're dealing with an owner or an agent. The first step of the scuttlebutt method is to become a connoisseur of corporate communications, primarily the annual shareholder letter. This is often the one place where the CEO speaks in a relatively unfiltered voice. You must read it not for the financial results, which are readily available elsewhere, but for the tone, the language, and the philosophy. An owner's letter, like those written by Buffett for Berkshire, or by Jeff Bezos in the early days of Amazon, reads like a partner talking to other partners. They are often long, detailed, and educational. They focus on long-term strategy, often discussing business metrics that don't show up in standard accounting, like customer loyalty or competitive advantages. Crucially, they are candid about mistakes. An owner is comfortable admitting failure because they know that business is a long journey with inevitable setbacks. An agent's letter, by contrast, is often a short, glossy marketing document filled with corporate jargon and platitudes. It focuses almost exclusively on the positive results of the past year and offers a vague, optimistic outlook for the future. Mistakes are either ignored or glossed over with euphemisms. It is not a document designed to inform. It is a document designed to manage perceptions. Step 2 is to listen to quarterly conference calls. Again, your focus is not on whether they beat the number by a penny. It's on how management answers questions from analysts. Does the CEO show a deep, granular understanding of the business operations, or do they deflect to the CFO for any detailed questions? Do they talk about building value over the next 5 years, or are they obsessed with justifying the last 90 days? Do they push back against analysts who are focused on short-term nonsense, or do they pander to them? An owner is playing their own game and is happy to explain their rules. An agent is playing Wall Street's game and is trying to say what the audience wants to hear. Step 3, if possible, is to experience the company as a customer. This was at the heart of Fisher's original method. Use the product, visit the stores, talk to employees. Do you get the sense that this is an organization focused on delivering real value, or is it just trying to extract as much money as possible from its customers? A culture of ownership permeates every level of an organization. Employees at an owner-operator company often have a sense of pride and purpose that is palpable. By combining these qualitative inputs, the letter, the conference call, the customer experience, you can build a mosaic, a psychological profile of the management and the company culture. This allows you to go beyond the numbers and answer the most important question. Am I partnering with a group of people who are obsessively focused on building a great, enduring business, or am I just renting the services of a temporary manager? The scuttlebutt method is your blueprint for finding out. The antithesis of the ownership mindset is the rise of the hired gun CEO culture, a phenomenon that has become increasingly dominant in modern corporate America. This is the path of the 99% of companies, and it represents a profound psychological departure from the owner-operator model. The hired gun is a professional manager, an agent in the purest sense. Their loyalty is not to a specific company, but to their own career trajectory. They often move from one CEO position to another every few years, like a highly paid free agent in professional sports. Their mindset is not one of long-term stewardship, but of short-term optimization. Their goal upon arriving at a new company is to quickly make a visible impact that will boost the stock price and enhance their own reputation. This creates a powerful incentive for actions that look good on the surface, but may be deeply harmful in the long run. They are masters of financial engineering, not business building. They will engage in restructuring and synergies, which often means mass layoffs that damage morale and institutional knowledge. They will sell off divisions that may be core to the long-term strategy, but are currently underperforming. Their primary tool is the management of expectations. They become experts at guiding Wall Street analysts to a quarterly earnings number they know they can beat, leading to a predictable pop in the stock price and positive press coverage. They are playing a game of perception, not a game of value creation. This culture is sustained by a system of perverse incentives. Executive compensation is often determined by compensation consultants who benchmark against other companies of similar size. This means that one of the easiest ways for a CEO to get a raise is to make the company bigger, not necessarily better or more profitable. This directly encourages the kind of value-destroying, empire-building acquisitions we've discussed. Furthermore, the golden parachute has become a standard feature of the hired gun's contract. This guarantees them a massive payout even if they are fired for poor performance. This completely severs the link between performance and financial outcome. It removes the fear of failure, which is the primary psychological driver of prudent behavior in the owner-operator. The hired gun CEO is playing with house money. The shareholder is playing with their own. The 99% of investors enable this system by failing to recognize it. They celebrate the arrival of a new star CEO, they applaud the bold restructuring, and they trade the stock based on the quarterly earnings game. They are unknowingly participating in a system that enriches the agent at the expense of the principal. They are investing in companies run by people with the mindset of a tenant, not the mindset of a homeowner. A tenant might not fix a leaky faucet, but you can be sure a homeowner will, because they know if they don't, the foundation will eventually rot. The direct financial connection between the ownership mindset and financial results is clear and powerful, primarily manifesting in two areas: superior margins and intelligent risk management. Let's look at the income statement first. An owner-operator like Mrs. B is, as we've seen, fanatically frugal. This isn't just a personality quirk, it's a strategic weapon. They view every dollar of expense as a dollar coming out of their own pocket. This leads to a relentless focus on operational efficiency. They will negotiate harder with suppliers. They will resist the temptation to build lavish corporate headquarters. They will avoid hiring unnecessary layers of middle management. This discipline shows up directly on the income statement in the form of a lower cost of goods sold and lower selling, general, and administrative (SG&A) expenses. Over time, this results in sustainably higher operating and net profit margins than their competitors, who are run by agents more concerned with budget size than efficiency. A company with a 15% net margin will compound shareholder wealth far more rapidly than a competitor with a 7% margin, even if their revenues are the same. This margin advantage, born from an owner's psychology, is a powerful engine of long-term portfolio growth. The second financial connection is more subtle but even more important: the management of hidden risks. An agent CEO is often incentivized to take risks where the potential rewards are visible and immediate: a higher stock price, a bigger bonus, while the potential negative consequences are hidden, delayed, or difficult to quantify. For example, they might cut corners on safety standards or environmental compliance to save money in the short term. They might build a complex financial structure using derivatives that boosts reported earnings but exposes the company to a catastrophic blow-up risk. These are the kinds of risks that don't show up on a standard balance sheet until it's too late. The owner-operator, driven by loss aversion, has a much deeper and more intuitive understanding of these hidden risks. Their goal is not just to win, but to survive. They are constantly thinking about what could go wrong. They will invest in redundant systems, maintain excess capacity, and prioritize a culture of integrity and safety, even if it costs more in the short term. They are inoculating the business against the low-probability, high-impact black swan events that can wipe out a company overnight. This focus on resilience may lead to slightly lower returns during a raging bull market, but it is precisely what allows the business to endure and thrive over multiple economic cycles. The financial payoff is not a single great year, but decades of uninterrupted compounding. By investing with owners, you are buying a form of insurance against the kind of catastrophic failure that plagues companies run by agents. This is the ultimate financial advantage, a combination of higher profitability in the good times and greater resilience in the bad. This brings us to our fourth pillar, a crucial journey into the heart of darkness. We must learn to identify the red flags and understand the path of the 99%, the specific ways in which misalignment manifests and destroys shareholder value. To truly appreciate the light of alignment, we must study the shadows of agency. The foundational anecdote here is not one of success, but of catastrophic failure. It is the story of the fall of Enron in 2001, a company that, for a time, was the seventh largest in America and a darling of Wall Street. Enron is the archetypal example of a business run by agents who perfected the art of appearing aligned while acting in precisely the opposite manner. The leaders of Enron, particularly CEO Jeffrey Skilling and Chairman Kenneth Lay, were masters of narrative. They spoke of a new economy, of transforming the staid energy business into a nimble, asset-light trading powerhouse. They were charismatic, brilliant, and celebrated on the covers of business magazines. They fostered a hyper-competitive, up-or-out culture where employees were ranked and fired based on short-term performance. Wall Street loved them. Analysts fell over themselves to praise their consistent, smooth earnings growth. The stocks soared, making many employees whose retirement funds were heavily invested in Enron stock paper millionaires. But beneath the surface, the incentive structure was pure poison. The company's executives were rewarded with enormous bonuses based on the reported profits of the deals they signed, not on the actual cash those deals generated. This created a massive incentive to do deals, any deals, and to use the most aggressive and fraudulent accounting possible to book immediate, imaginary profits. The entire company became a machine for manufacturing the appearance of success. The misalignment was total. While executives like Skilling and Lay were publicly exhorting employees and investors to buy more Enron stock, proclaiming it was ridiculously undervalued, they were privately and frantically selling their own shares. SEC filings later revealed that in the year leading up to the bankruptcy, top executives sold hundreds of millions of dollars worth of their own stock. They knew the company was a house of cards, built on a foundation of lies and off-balance sheet debt. Their actions screamed one thing: get out. Their words, however, told a different story. They were the ultimate agents, using their inside knowledge to save themselves while leaving their supposed partners, the shareholders and employees, to face complete and utter ruin. When the music finally stopped in late 2001, Enron collapsed into the largest bankruptcy in U.S. history at the time. The stock went to zero. Thousands of employees lost not only their jobs, but their life savings. It was a financial tragedy born directly from a moral and structural failure. A management team with zero real skin in the game, whose incentives were geared entirely toward short-term deception rather than long-term value creation. The psychological principle that allowed the Enron disaster to happen, and that continues to trap the 99% of investors, is a deadly cocktail of overconfidence bias and the herd-like behavior driven by social proof. These biases create a fog that obscures the clear red flags of misalignment. Overconfidence bias is the tendency for people to have excessive faith in their own judgments and abilities. The executives at Enron, lauded as geniuses by the media and Wall Street, came to believe their own hype. They believed they were smarter than the old rules of accounting and business, that they could manage risks that no one else could. This arrogance led them to build a system of such complexity and opacity that they likely lost control of it themselves. This same bias affects investors. When a stock they own is going up, investors feel like geniuses. Their confidence soars. They become less likely to question the underlying fundamentals or the incentives of management. The rising stock price itself becomes the justification for owning the stock, a dangerous circular logic. This is where social proof pours gasoline on the fire. Social proof is our tendency to assume that the actions of others reflect the correct behavior in a given situation. If all the Wall Street analysts are recommending a stock, if all the major mutual funds are buying it, if all the financial news channels are praising the CEO, the average retail investor feels a powerful psychological pressure to conform. They must know something I don't, is the subconscious thought. It feels safe and comfortable to be part of the herd. Enron was the ultimate example of this. The social proof was overwhelming. To question Enron in the late 1990s was to mark yourself as someone who didn't get it, who was stuck in the old ways of thinking. The herd was stampeding in one direction, and very few had the psychological fortitude to stand apart from it. The combination is lethal. Overconfidence in your own judgment, reinforced by the social proof of the herd, makes you blind to the most obvious warning signs. Investors in Enron could have looked at the proxy statements and seen the massive insider selling. They could have read the financial statements and noted the incomprehensible complexity and the divergence between reported earnings and actual cash flow. But they didn't. They were trapped in a psychological echo chamber, where the story was more compelling than the facts. This is the path of the 99%. They outsource their thinking to the herd, they fall in love with a good story, and they ignore the fundamental analysis of incentives, because it's hard work, and it often leads to an uncomfortable contrarian conclusion. They choose the comfort of the crowd over the logic of alignment, and they often pay a terrible price for it. To avoid this fate, you need a practical mental model for spotting these red flags. You need an incentive structure audit, a checklist to run on any company that helps you cut through the noise and see the reality of the alignment. Step 1 of this audit is to dissect the compensation plan, which is described in excruciating detail in the, quote, compensation discussion and analysis section of the proxy statement. This is dense reading, but it's where the secrets are buried. Your first question: what is the mix between fixed salary and performance-based pay? A high fixed salary, regardless of performance, is a red flag. It rewards presence, not results. Step 2. For the performance-based pay, what are the specific metrics being used? This is the most important question. Is the bonus tied to long-term, value-creating metrics like return on invested capital, ROIC, or growth in intrinsic value per share? Or is it tied to short-term, easily manipulated metrics like revenue growth, adjusted earnings per share, which can exclude all sorts of bad costs, or simply the stock price over a short period? If the incentives are tied to short-term metrics, you can predict the behavior. The management will do whatever it takes to hit those metrics, even if it harms the business in the long run. Step 3 is to analyze the structure of the equity compensation. Are executives given stock options or restricted stock units? As we've discussed, options with a low strike price are a one-way bet that encourages excessive risk-taking. Restricted stock, which is an outright grant of shares that vests over time, is better, as it forces the executive to participate in the downside. Even better is a requirement for executives to use their own cash to buy shares on the open market, or to hold a significant portion of their shares for many years, even after they leave the company. This creates true long-term ownership. Step 4 is to look for quote, 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 a quote, and other egregious perks. Does the CEO's contract guarantee them a massive payout if the company is sold or if they are fired? This can incentivize a CEO to sell the company at a suboptimal price just to trigger their payout. Lavish perks like personal use of corporate jets, expensive club memberships, and overly generous retirement plans can also be a sign of a management team that views the company as their personal piggy bank. Running this audit gives you a clear, objective picture of the incentive structure. It allows you to answer a simple question: is this compensation plan designed to reward the creation of long-term, sustainable value for shareholders, or is it designed to enrich the management team as quickly as possible with little regard for the consequences? The answer will tell you almost everything you need to know about whether you found a partner or just a hired hand. The antithesis of this diligent audit is the path most retail investors take. They blindly trust the narrative spun by Wall Street and the financial media. This is a critical mistake because the incentives of these institutions are often just as misaligned as those of the CEOs they cover. Wall Street analysts, for the most part, are not paid to provide accurate, unbiased research to the public. They work for investment banks that have a strong incentive to maintain positive relationships with the companies they cover. A negative sell rating on a company could jeopardize a lucrative future banking deal, like underwriting a stock offering or advising on an acquisition. As a result, sell ratings are notoriously rare. The vast majority of ratings are buy or hold. The analyst's job is not to tell you the truth. It is to support the business of the investment bank. The financial media, while often providing a valuable service, also has its own set of perverse incentives. Their business model is based on attracting eyeballs and clicks. They need to generate headlines and tell compelling stories. A story about a visionary CEO revolutionizing an industry is far more exciting than a story about a boring, conservatively managed company that is slowly and steadily compounding value. A story about a soaring stock is more appealing than a story about a fairly valued one. This leads to a natural bias in coverage toward the exciting, the new, and the dramatic, the very story stocks that are often led by charismatic but unaligned CEOs. The 99% of investors consume this media as if it were objective truth. They see a buy rating from a famous analyst and take it as a signal to purchase. They read a glowing profile of a CEO in a magazine, and become convinced of their genius. They are essentially allowing their investment decisions to be dictated by people whose primary goal is not to make them money, but to serve their own institutional or commercial interests. They fail to do the primary source work, reading the proxy statements, listening to the conference calls, performing the incentive structure audit, and instead rely on the filtered, biased, and often misleading conclusions of others. This is the intellectual laziness that leads directly to owning a portfolio of Enrons. It is the abdication of your most important responsibility as an investor, to think for yourself and to trust only those whose interests are demonstrably and overwhelmingly aligned with your own. The direct financial connection of misalignment is not just underperformance, it is the risk of catastrophic, permanent loss of capital. This is the ultimate price of ignoring the red flags. First, let's consider the financial impact of value-destroying acquisitions. When an empire-building CEO uses overvalued company stock or takes on massive debt to buy another company at a premium, the effect on the balance sheet is immediate and devastating. The company's book value is often impaired by a huge amount of goodwill, which is the accounting plug figure representing the premium paid over the fair market value of the acquired assets. If the acquisition does not work out as planned, and most do not, the company is eventually forced to take a goodwill write-down, an admission that they overpaid and destroyed shareholder capital. This is a direct, quantifiable destruction of the shareholders' equity. Second, look at the effect of excessive stock-based compensation. When a company constantly issues new shares and options to its employees and executives, it dilutes the ownership stake of the existing shareholders. Imagine you own 1% of a company with 100 million shares. If the company issues another 10 million shares as compensation, your ownership stake is reduced to just 0.9%. The pie has been cut into more slices, and your slice is now smaller. While some stock-based compensation is necessary, many companies, particularly in the tech sector, use it so excessively that it becomes a massive hidden cost to shareholders. The company might report a profit, but the per-share value is actually stagnant or declining because of the constant dilution. The ultimate financial consequence, as seen in the Enron case, is total failure. The fraudulent accounting, the hidden debt, the excessive risk-taking, all born from a poisoned incentive structure, can lead to bankruptcy. In this case, the stock price goes to zero. The shareholders' investment is completely and permanently wiped out. This is not a theoretical risk. It has happened time and again throughout financial history, from Enron to WorldCom to the major banks in the 2008 financial crisis. In almost every case, a diligent audit of the incentive structure and a clear-eyed analysis of insider behavior would have provided ample warning of the coming disaster. The financial connection is therefore brutally simple. Alignment reduces the probability of these catastrophic outcomes. Misalignment dramatically increases it. By making the analysis of incentives a non-negotiable part of your investment process, you are not just searching for stocks that can go up, you are systematically eliminating the ones that can go to zero. It is the single most effective risk management tool an investor has. Finally, we arrive at our fifth and most practical pillar, the owner's manual. This is your actionable blueprint for finding and investing alongside aligned leaders. We've explored the why, now we delve deep into the how. This is where theory becomes practice, and where you gain the skills to transform your portfolio and your financial future. Our foundational anecdote for this pillar is Warren Buffett's investment in the Washington Post Company in the early 1970s. This story is a masterclass in the research process, showing how to combine quantitative analysis with qualitative judgment to gain true conviction. In 1973, the stock market was in a funk, and newspaper stocks were particularly out of favor. The Washington Post, despite being a premier media franchise with properties like the newspaper itself and Newsweek magazine, was trading at a ridiculously low valuation. The entire company had a market capitalization of around $80 million. Buffett, doing his scuttlebutt, quickly realized that the company's assets, if sold off individually, were worth at least $400 million, maybe more. This was a classic Ben Graham-style cigar butt investment, where the company was worth more dead than alive. But for Buffett, that wasn't enough. He wasn't interested in buying the company to liquidate it. He needed to believe in the people who were running it. The company was controlled by the Graham family, specifically by Catherine K. Graham, who had taken over as publisher after the tragic death of her husband. She was a formidable, intelligent leader, but she was still finding her footing in a male-dominated industry. Buffett's due diligence went far beyond the numbers. He read years of the company's annual reports. He spoke to people throughout the newspaper industry. He developed a deep admiration for the integrity and long-term vision of the Graham family. He saw that their identity, their reputation, and a massive portion of their family fortune were all tied up in the success of the Post. They were not agents. They were stewards of a legacy. This gave him the confidence he needed. He saw a combination of a phenomenal business, a dirt-cheap price, and, most importantly, a management team whose interests were perfectly aligned with his. He began buying the stock aggressively, investing over $10 million, a huge sum for his then-fledgling Berkshire Hathaway. He became a director on the Post's board and a close friend and advisor to K. Graham. Over the next 3 decades, that $10 million investment would grow to be worth well over $1 billion. The story of the Washington Post investment is the perfect blueprint. It demonstrates the multi-layered process. Start with the quantitative valuation to identify a potential opportunity, but then, crucially, do the deep qualitative work to verify the character and alignment of the people in charge. It is the synthesis of Graham's numbers-focused approach and Fisher's people-focused approach, creating a powerful holistic investment methodology. The underlying psychological principle that makes this deep-dive research so critical is the need to overcome our own cognitive shortcuts, specifically confirmation bias and the availability heuristic. If we are not careful, these biases will lead us to make lazy, surface-level decisions. Confirmation bias is our natural tendency to search for, interpret, favor, and recall information in a way that confirms or supports our pre-existing beliefs. If you hear a good story about a company and form an initial positive opinion, your brain will subconsciously start looking for evidence that supports that opinion. You'll pay more attention to positive news articles. You'll interpret the CEO's confident statements on a conference call as proof of their brilliance, and you'll dismiss negative information as irrelevant noise. You will stop being an objective investigator and become a cheerleader for your own idea. The availability heuristic is a mental shortcut that relies on immediate examples that come to a given person's mind when evaluating a specific topic. We tend to overweight information that is recent, vivid, and easy to recall. A company that just reported a great quarter and is being featured on financial news shows is highly available in our minds. We might be tempted to invest based on this easily accessible information. Assuming it's the most important data, we ignore the harder-to-find, less available information, like the details of insider ownership buried on page 47 of a 120-page proxy statement, even though that information is far more predictive of long-term success. A rigorous, process-driven research plan is the only antidote to these biases. The owner's manual, with its specific steps and checklists, acts as a brake on our own flawed mental machinery. It forces us to confront disconfirming evidence. It compels us to seek out the less available but more important data. By committing to a process, you are pre-committing to being rational. You are creating a system that protects you from your own worst psychological instincts. The process of reading the proxy statement, of analyzing the compensation plan, of listening for cues in the shareholder letter, is not just about gathering information about the company. It's about forcing your own brain to slow down, to think critically, and to make a decision based on a complete set of facts rather than a flimsy, biased first impression. This is how professional investors separate themselves from amateurs. Amateurs follow their gut feelings and the latest headlines. Professionals follow a disciplined, repeatable process designed to counteract their own biases. This brings us to the core of the owner's manual, the proxy statement deep dive. This is the applied mental model, the step-by-step, granular instruction manual for uncovering the truth about management alignment. Step 1. Obtain the document. Go to the Investor Relations section of the company's website. Look for SEC filings, find the most recent DEF 14A or proxy statement. Download the PDF. This is your primary text. Step 2. Find the ownership table. Use the search function Ctrl-F and type security ownership. This will take you to the security ownership of certain beneficial owners and management table. This is your ground zero. The table will list the names of the CEO, CFO, other top executives, and all the directors. Next to their names will be the number of shares they beneficially own. Pay close attention to the footnotes, as they will explain how these shares are held. Step 3. Calculate the key ratios. Find the total number of shares outstanding for the company. This is usually available on any financial website or at the top of the SEC filing. Divide the total shares owned by management and the board by the total shares outstanding. This gives you the insider ownership percentage. As we've discussed, anything over 5% is interesting. Over 20% is often a sign of a true owner-operator culture. Next, calculate the value of the CEO's ownership. Multiply the number of shares they own by the current stock price. Now, go to the compensation section of the proxy and find the CEO's total compensation for the last year. Compare the two numbers. Is the value of their stock holdings a significant multiple of their annual pay? The higher the multiple, the stronger the alignment. A CEO with 20 times their salary in stock thinks very differently than a CEO with only 2 times. Step 4. Read the Compensation Discussion and Analysis, CD&A. This is the narrative section where the company's compensation committee explains its philosophy and the metrics it uses to award bonuses and equity. As you read, apply the checklist from our incentive structure audit. Are they using long-term metrics like ROIC or short-term metrics like adjusted EPS? Is the language clear and straightforward, or is it filled with confusing jargon designed to obscure? Look for any related party transactions, where the company might be doing business with other companies owned by the executives or their families. These can be a major red flag. Step 5. Synthesize and decide. Take all this data, the ownership percentage, the ownership to pay ratio, the quality of the compensation plan, and weigh it against the qualitative information you've gathered from the annual letter and conference calls. Now, and only now, after this deep dive, are you in a position to apply the family net worth test with any degree of accuracy? Can you confidently say that this management team is in the boat with you? The proxy statement deep dive is not easy. It requires time and effort, but it is the single most valuable work you can do as an investor. It is the process of turning over the rocks and finding the information that the 99% of investors will never bother to look for. It is your blueprint for building a portfolio of true partnerships. The antithesis to this diligent, primary source research is the lazy approach taken by the vast majority of retail investors. Their path is one of intellectual shortcuts and a reliance on secondary, often unreliable, information. The most common mistake is an over-reliance on simple stock screeners. An investor might go to a financial website and screen for stocks with, for example, a low PE ratio and high revenue growth. The screener spits out a list of names, and the investor starts buying without any further research. They are making a decision based on 2 or 3 isolated data points, with no context about the business quality or, more importantly, the alignment of the management. They are mistaking a shallow quantitative snapshot for a deep business analysis. They have no idea if the low PE ratio is a sign of a bargain or a value trap, or if the high revenue growth is profitable and sustainable, or the result of a value-destroying acquisition binge. Another common lazy approach is to simply buy what you know. While this can be a good starting point, it's often a trap. An investor might like a company's product, so they buy the stock, assuming that a good product must mean it's a good investment. They never bother to check the valuation, the balance sheet, or the insider ownership. They are being a good consumer, not a good investor. The skills required for the two are completely different. A company can have a fantastic product that everyone loves, but still be a terrible investment if it's run by a misaligned management team that is diluting shareholders and destroying capital behind the scenes. The ultimate lazy approach is to simply follow the hot tips from friends, family, or anonymous posters on internet forums. This is not investing, it is gambling. It is the complete abdication of personal responsibility. The investor is acting on zero information, based on the unsubstantiated claims of a source whose credibility and motives are completely unknown. By choosing these paths of intellectual laziness, the 99% of investors ensure that they will never have a real informational edge. They are destined to buy high, sell low, and perpetually wonder why they can't seem to make money in the market. They are ignoring the single most important rule of the game: do your own homework. The proxy statement deep dive is that homework. It is the hard work that separates the successful long-term investor from the frustrated speculator. The direct financial connection of this diligent research process is the cultivation of a rare and powerful asset: genuine conviction. In the world of investing, conviction is the currency that allows you to act when others are paralyzed by fear and to be patient when others are consumed by greed. When you have only done a surface-level analysis, your conviction in an investment is shallow. As soon as the stock price falls or the company hits a rough patch, that conviction evaporates. You panic and sell at the worst possible time, locking in a loss. Why? Because you never truly understood what you owned. Your decision to buy was based on flimsy evidence, so your decision to sell is driven by pure emotion. However, when you have completed the owner's manual process, when you have read the last 10 years of annual reports, when you have dissected the proxy statement, when you know the management team's philosophy inside and out, you develop a deep, resilient conviction. You understand the business's long-term value. You trust the people running it. When the stock price falls due to a temporary market panic, you don't see it as a threat. You see it as an opportunity. Your deep knowledge allows you to act rationally while others are behaving irrationally. You might even buy more, confident that the aligned management team will navigate the downturn and emerge stronger. This ability to be a buyer when everyone else is selling is a massive source of long-term outperformance. Financially, this conviction translates directly into a lower portfolio turnover rate. You are not constantly trading in and out of positions, racking up transaction costs and taxes. You are buying great businesses run by great people and holding them for years, allowing the magic of compounding to work its wonders. Lower turnover means lower costs, which directly boosts your net returns. Furthermore, this conviction allows you to build a more concentrated portfolio. If you have deep knowledge of your holdings, you don't need to own 50 or 100 different stocks to feel safe. You can own a smaller number of high-conviction ideas, which gives your best ideas the room to have a meaningful impact on your overall portfolio growth. This is the direct financial payoff of doing the hard work. The research builds conviction, and conviction is the psychological bedrock that enables the kind of patient, contrarian, and concentrated investment strategy that has been proven to generate superior capital gains and build lasting wealth over the long term. You have just completed an intensive journey. You've absorbed a powerful mental model that cuts through the noise of the market and goes straight to the heart of what makes an investment truly successful. You now understand that the ultimate signal, the final promise of a management team that will treat your money like their own, is their own money. It is the principle of skin in the game, the unwavering alignment of interests between the people running the business and you, the owner. You now possess the tools to dissect this alignment, to read the primary documents, to understand the psychological drivers, and to spot the red flags that 99% of investors miss. This knowledge is more than just a tactic. It is a fundamental shift in perspective. It is a filter that, if applied consistently, will protect you from catastrophic losses and dramatically increase your odds of achieving financial independence. But it is crucial to understand that what you have mastered today, as powerful as it is just one critical node in a much larger network of wisdom. Warren Buffett's success is not built on a single trick or a secret formula. It is built on what Charlie Munger calls a latticework of mental models, a collection of interconnected principles from business, psychology, and science that, when combined, create a powerful tool for understanding reality and making rational decisions. You have forged a key, but it is a key to a single essential room in a vast palace of knowledge. The principle of shareholder alignment is the foundation, but what about the models you use to determine what a great business even looks like? What about the psychological tools needed to control your own emotions during the inevitable panics and manias of the market? The map you have is powerful, but it is incomplete. The video that is now appearing on your screen is not an accident. It is not just another piece of content. Think of it as the next piece of the map. It is the link that connects the principle you just mastered to another, equally critical concept in this latticework. It is the bridge from understanding the who to understanding the what and the when. The decision to click is not about watching another video. It is a choice about your own identity. Are you a dabbler, someone who collects isolated pieces of information? Or are you a serious student of success, someone committed to assembling the complete mental arsenal required to navigate the complex world of investing and business? The journey to mastering this latticework is a marathon, not a sprint. The next step is right in front of you. Complete the connection. Continue your ascent. Click. And acquire the next piece of your arsenal.